Okay, good morning and happy Friday. Welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we have a lot to cover with you here today as we had a very violent sell-off here yesterday. So I want to talk a little bit about what happened, potentially what caused it, and more importantly, how do we move forward from here? Because this sell-off that we had yesterday is, in my opinion, actually a good opportunity for us here in the market. So before I get started, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So first off, I want to start off by talking and understanding a little bit about this market sell-off. I want to talk about what caused it, understanding it a little bit so that you have a better understanding as to how to proceed forward. And then we'll talk a little bit about the market update, meaning where do the broader markets currently sit? Where is it in the context of the big picture? Because if we look at it from the big picture, as you're going to see, there are some opportunities as a result of it. We're also going to take a look at how this has affected volatility and rates. That gives us some view as far as the directional view going forward. And then looking at economic and mobility metrics. Economic numbers, employment numbers came out this morning better than expected. That is part of the thesis that we have as far as why we see opportunities in this market. Mobility also seemingly picking up. So these are some of the better trends that we're currently looking at from high frequency data. And then what I want to share with you is some of the ideas that we have here, both from the equity markets and perhaps some non-traditional ideas as well. And at the very end, if we have a few minutes, I'll open this up for Q&A before we get started. So let's go ahead and talk about what we're currently seeing in the market. But predominantly the question that we've been getting overnight is really what drove the sell-off yesterday and where are we headed next? So that's what I'm trying to hopefully help everyone have a better understanding after today's session. Now, today, what I'm going to do is I'm going to share with you my research, my technical analysis charts to give you a better understanding as to how I'm viewing this market from a broader perspective, some of my economic data that I'm currently paying attention to, and the ideas that we are scanning for in this current market. So I'm going to start off by talking about what drove yesterday's sell-off. So one of the things that we have to pay attention to, and this is something that I've been talking about for weeks on end now, which is the put-call ratio. We've been talking about how the put-call ratio, the 20-day put-call ratio, even the 20-week put-call ratio has been in this very complacent area for a long time. So what we were basically seeing was a lot of call buying and a huge acceleration of call buying with not the corresponding same number of put buying. And what was very different about this particular market, number one, is that we've never seen this amount of call buying with the lack of put buying at the same time. But more importantly, it's not just that there were more calls than puts that were traded. More importantly, it's which types of calls that were traded. And predominantly what we have been seeing over the past couple of weeks and past arguably month or so is these really far out of the money calls that were being purchased. This is what some are calling the Robin Hood effect, where you have millennials that don't have a lot of capital trying to play Apple stock that was trading at $400, and they simply don't have the capital to buy 100 shares of the stock or even a few shares of the stock. So what do? They buy these really far out of the money call options that only cost 10, 50, maybe a couple of dollars or so on a stock that normally would cost you $1,500 to buy an at the money contract. And these types of contracts, they weren't just buying really far out of the money calls, they were buying very short dated out of the money calls. Now, for those of you that have been following us for a while, you know that we advocate that you never ever sell short dated options because of something that we called gamma risk. Because what happens is short dated options have high amount of gamma, meaning the delta will shift very, very quickly. So what drove this market sell-off was predominantly you have a lot of people buying these really far out of the money call options on Apple and Tesla, and they're doing it because it has worked for quite some time, where you buy maybe a call option, a really far out of the money call option for $1, and when the stock jumps 10%, that $1 call option might become a $3 call option. You make a 200% return, and you keep rolling that over and over again. But the problem here with these really short dated out of the money call options is, for a market maker, these are extremely difficult for them to hedge because the short dated options have high amounts of gamma. So as the as these call buys, as these really far out of the money call options are being purchased, the market makers continuously have to buy calls. And because the gamma on these are relatively high, when stocks like Apple and Tesla are up 30% in a few weeks' time, these market makers have to buy a large amount of the underlying shares to continuously hedge the 5 delta, 10 delta calls that they've sold. And what this does is that even though, we're trading in a market that's, considered fairly liquid, the liquidity of the markets have actually evaporated quite a bit over the past few weeks. For those of you that track our liquidity tracker, you'll notice that we were looking at about 200, 230 very liquid names. That has evaporated to just, less than 100 over the past week or so. So liquidity has actually been evaporating. So what you have is this kind of perfect storm, if you will, of market makers that are buying large amounts of Apple and Tesla stock, driving these stocks higher because of the gamma exposure that they have. And all you need is one down day, which is, the markets opened up a little bit lower yesterday, and we're right by near expiration when gamma is highest. And what happens is you get an acceleration from market makers that have been buying a ton of this stock to all of a sudden shifting to having to sell a lot of this stock, because these 5 delta calls are extremely sensitive to delta, because gamma on those, the gamma exposure on these stocks are extremely, extremely large. And when you have such concentration in Apple, Tesla, and just a few tech names where all the call buying is happening, this is what exacerbated yesterday's sell-off here. So that is what caused the sell-off. But on that what that also means is that this was not caused by some kind of larger structural fundamental shift in the markets. This was simply just positioning for market makers from being very long Apple stock, needing to all of a sudden shift their positions to being shorting, and selling a lot of this Apple and Tesla stock. And which is predominantly why you saw most of the moves yesterday was fairly concentrated in technology. If you look at small caps, if you look at equal weight, this wasn't happening. So this is part of the opportunity that we see in the markets, is that this sell-off yesterday is a more temporary sell-off. It actually resolved a lot of the things that we've been talking about over the past month or two about markets are being exhausted. We're seeing negative divergence. We're seeing overbought indicators. This resolved almost all of that pretty much overnight. And this puts us back into a much more normal, much more healthy market. So this is really where we can see some opportunities. So that gives you a better understanding as to what caused yesterday's sell-off. So now let's talk about where do we currently stand and where we are likely going to move forward. So if we look at the Qs, the NASDAQ 100 index, we've been talking about the fact that this is fairly overbought. We continue to see exhaustion here in this markets. And in a single day, we now managed to correct ourselves back to that 20-day moving average. The 20-day moving average that I continue to talk about as the buying opportunity. When you get below that 20-day moving average, those are your buying opportunities, as we've seen over and over again on the Qs. And that's exactly what we got here yesterday. We touched just below the 20-day moving average, and we're now opening up just above that. So this is in my opinion, an opportunity. We see the same thing in the S&P 500, which also was overbought, starting to see the same signs of exhaustion, now pulling back to its 20-day moving average, and again, providing some potential upside here. Now, the other indicator that gives us a better understanding that this isn't some kind of larger structural shift in terms of how markets are viewing, whether it's from an economics or COVID perspective, is really looking at the broader market. If we look at small caps did not sell off very much yesterday when the NASDAQ sold off 8%. This is telling us that the rest of the market is not, this was basically froth of the market, basically kind of, I would say, resolving itself, if you will, that there isn't a larger structural shift to, taking a look at perhaps downside or further downside here in the markets. Could we see a little bit more selling here in some of the tech names? Absolutely. And I think you're going to see some of that here today, especially in some of the, such as names like NVIDIA. You might continue to see some sell-offs, but overall, I think that you are likely going to see more buying rather than selling going forward. So we see this on small caps. We also see this on equal weight. Equal weight barely nudged yesterday, down less than about 2%. So this shows us that, again, we're rotating out of these technology names back into some of these value names. Now, this rotation is unlikely going to last very long, in my opinion. I think we're likely going to see flow back into discretionary, into technology. This cycle may continue again, but I certainly think some of the short-term players certainly got squeezed out. So this is, again, why we always advocate don't trade those really short-dated options, because if you got squeezed out yesterday and you had options that expire today, unfortunately, you're unlikely going to get yourself back to break even. This is why we roll options 3 weeks in advance. This is why we sell options 45 days out, so that you have the opportunity to roll those positions after a day like yesterday and potentially get yourself back to break even, in the next couple of cycles. This one day is not wiping out a very large portion of your accounts. Unfortunately, and I do say unfortunately, because if you look at Twitter, if you look at Reddit and you read those the forums that a lot of these Robinhood traders are on, I have seen plenty of screenshots of people who have lost 70 to 80% of their entire account values yesterday, because what they're doing is they're trading really short dated options and they have no opportunity at this point to roll them out at any point, because whatever premium they had, there's nothing left, and whatever short positions that they have, they simply don't have enough to cover them and roll them out. So this is the type of trading that we always we always advocate that you avoid these short-term plays, so that when you get these one-day squeezes, they don't blow up your entire accounts. And I know some of you still like to sell those, 1 week, a few day options, picking something 3-4% out of the money, hoping that they expire worthless. And that has worked predominantly for the last few months. And all it takes is one bad day to wipe all of those gains out potentially. So this is, again, why we advocate don't use those types of options. And the other indicator that we basically saw was that fixed income markets barely budged here yesterday after, we saw this spectacular sell-off here in technology stocks. This is also an indication that this isn't some kind of larger structural shift to fundamentals or economics that's going to drive, some kind of market correction here. This is a short-term temporary correction back in line with what we consider a more healthy market. And that is the opportunity that we see. So for those of you that have been following us for a few months now, as you know, one of the indicators that we pay attention to quite a bit is the ratio of the 3-month VIX to the 1-month VIX. And that is back into what we would consider fairly neutral territory. And whenever we consider this as neutral, that actually means a bit more of a bullish wind, if you will, to the markets. Until this gets below 1, that's when we would consider risk off, and it's time to potentially look for short opportunities and put on puts and protection on your portfolio. Right now, we're back in that neutral territory. So this, again, backs up our more bullish thesis here going forward. Now, if we look at the VXN, this is the NASDAQ 100 volatility index. So the VIX, but for the NASDAQ 100 index, this reached a new 4-month high here yesterday. So volatility on tech stocks at a 4-month high. This provides some opportunities if you're looking for some of the tech names that have stronger balance sheets that are likely going to do fairly well over the next couple of days. Selling volatility is certainly going to be one strategy that we're going to be looking towards. That's why the daily play for today is selling a put credit spread here on Apple. I know it was a little speculative and a little weary yesterday as to whether or not that was a trade that was a smart idea. But looking at employment numbers this morning, looking at where markets are reacting to that, I certainly think that that's still a valid trade. So for those of you that are thinking about whether that's a trade that you're going to execute, that is certainly one that we are looking to execute here this morning. Because of the high implied volatility we're seeing in these technology stocks, you're going to be able to collect a fair amount of premium. And I always advocate in these types of market sell-offs, if you're trying to buy the dips, do so with strategies that have limited risk, right? It's always possible that this sell-off accelerates, that the gamma of the markets actually get worse. I don't think it is going to, because these trades that these really far out of the money options typically trade are very short dated options. So they typically don't extend out over multiple weeks. But it is possible that you still get another an acceleration to the downside here today. But I think that is the limit as to what you're going to see. But still, always protect yourself using limited risk strategies such as put credit spreads. Now, as you can see, the S&P VIX has not, or the VIX on the S&P has not moved to those same 4-month highs, is actually retreating quite a bit here today. So again, this is our thesis that volatility picked up. This is an opportunity to sell into that volatility, whether you're selling put credit spreads on stocks that you think are going to be bullish, or call credit spreads on more bearish stocks, or even cover calls on some stocks that are just trading sideways. This is a better opportunity to collect more premium. So that is where we currently stand from the broader markets, where volatility sits, and the fact that the fixed income markets hasn't moved very much. This again, this again provides our thesis for why we think the opportunities going forward is still on the long side. But if we look at employment data, this is really where employment data started to tick up. Unemployment started to tick up a little bit here this week. So about 1.59 total unemployment claims between states and federal unemployment. And as you can see, federal total unemployment still in the high 20 million. So employment numbers still not particularly strong, but we did have the breaking news this morning, which is a non-farm payroll. This is the one that I talked about on Tuesday. We said that the estimate was about 1.3 million added jobs with an unemployment rate of about 9.8. As you can see, the number came out substantially better than that. This is This is what we have seen month after month over the past 4 months, where non-farm payroll came out way better than consensus. Unemployment came in significantly better than expected. And this is what's been driving, the markets have been reacting fairly positively to these news every single month. So it's been no different this month. We saw markets react positively here this morning, basically erasing all of the overnight losses on the S&P, on the Dow, on the NASDAQ 100. S&P is actually now positive from the overnight session. So this is likely why I think this could be a temporary bottom here for the markets. Now, there's also some good news on the mobility side. So this is high frequency data that helps us track kind of the shape of the recovery and the speed of the recovery. So over the past few weeks, we've talked about how this recovery has predominantly stalled, but we've seen a bit of an acceleration here over the past couple of weeks. And this lines up fairly well with the decline in COVID-19 cases that we've seen over the past month or so. We were expecting that this was going to accelerate to the, or actually, sorry, not accelerate, but uptick, start shifting a little higher here over the past couple of weeks. This does line up with the COVID data. Also, if you look at open table seating, and this is more real-time data, as you can see, more and more people are going out to restaurants and booking seats in restaurants, and this is across the board, whether you're in a part of the country that has largely still kind of remained in lockdown or reopened. We're seeing this type of trend across the board. The one thing I will say is that the 7-day average of COVID cases has started to level off a little bit, around 42,000 cases. So we are going to pay close attention to whether this mobility data continues to move higher or starts to stall again, because we have seen this data point stall when number of COVID cases start to pick up. And we have seen a few hot spots with North and South Dakota. We've seen it in Iowa, where we've seen new spikes of cases that can't be explained by the increase in terms of testing. So there's still a lot of things that are at play here, but the high frequency data is starting to show a little bit of improvement, which is good given the improvement we've seen in COVID cases over the past few weeks. So with that, what I want to do now is take a look at some of the opportunities that we see in the markets. And this really comes down to, from my perspective, a few things that I'm looking at for opportunities in this market. Number one, yesterday's sell-off gave us a very strong technical sell-off, which provides much better risk-reward ratios if you're looking for a long. Markets have gotten so stretched and exhausted here over the past few weeks, it was really difficult to justify continuing to go long, even using options. But yesterday's sell-off provides us with a lot of opportunities. So what we want to do is we want to couple those technical entry points that have a fairly attractive risk-reward ratio with some of the fundamentals, meaning which stocks that are fundamentally sound and strong also exhibit this type of technical opportunity that we see. So the names that we're going to show you here today are ones that scan well on both the technical sell-off side with in terms of risk reward, as well as the fundamentals. So Facebook was one that I brought up here. I forget if it was Tuesday or last Friday as a breakout candidate. I was saying that as the fact that Facebook, you know, has not gone parabolic like Apple and Tesla, but is still one of the major weights in the NASDAQ 100 index, that was a better opportunity if you're looking for tech. So Facebook did pull back, didn't quite get to that 20-day moving average, but is now broken out here to the upside. New 52-week high this morning. So this is, in my opinion, a potential breakout opportunity outside of the Apple and Tesla names. We're seeing rotation out of Apple and Tesla into a name like Facebook. And this could be potentially the type of name that maybe goes a little bit parabolic here over the next couple of weeks. This is a breakout opportunity. Now, most of the opportunities that I see aren't quite as strong as this, but this is certainly one that, even though it's been on my radar for a couple of weeks, I think has a potential trigger point right now. If we look at Twitter, this is one that I've remained bullish on pretty much since the beginning of the coronavirus. It has been a low and slow but steady kind of play. It hasn't gone parabolic. If you think about the fact that you know, the fundamentals here look fairly strong here for Twitter. Technically, I like the fact that you've had a pullback here after having that kind of a parabolic move, and it looks like it can continue moving higher. Take advantage of the high implied volatility and look at selling put credit spreads. I would look at maybe like a 41.38 put credit spread, something like that, where I sell the 41 and buy back the 38 going out to maybe October or so. Those are the types of plays that I would be looking for here for Twitter. Another one, CHRW, an industrial transportation stock. So we saw a little bit of rotation into transportation and industrials over the last few weeks, and also yesterday after the during the sell-off. This is one of the sectors that remained relatively robust and resilient during the sell-off here yesterday. So we got the pullback into the 20-day moving average range. This is a strong stock from a fundamentals perspective. So this is an opportunity that I see also. This is one that you could also look at potentially buying some call spreads, but again, the increased implied volatility certainly makes that a little bit more expensive. So I would lean more towards selling put credit spreads rather than buying call spreads here. But you know, if you are playing for that breakout, I do think that there is opportunity also on the call side as well. Another one is Google. You know, if we look at Facebook, Google, very similar business models. Google did pull back substantially more. And I think this, again, pulling back to that 20-day moving average is the opportunity here. As you can see, there's a fair amount of upside here. So Google, obviously an expensive stock. So use options to try to protect yourself, either using call spreads or selling a put option. And because it's such an expensive stock, maybe some investors here might just prefer to buy the stock rather than an option here, buy a few shares of the stock, depending on how much capital you're looking to allocate to trades like this. But again, yesterday's sell-off provides us with an opportunity to buy these stocks at a significantly cheaper discount than where they were trading just a few days ago. Amazon, also same thing, resilient company from a fundamental perspective. Yesterday's sell-off did not change anything from a fundamentals perspective. You're basically able to pick up the stock at a relatively cheaper price. You know, you've had this let's just call it a consolidation range for quite some time, where you've had this range that it's been trading in for quite some time. You had that triangle, you had the breakout. Now it's come back to retest this as support. And this is your possibility of a continuation longer here. So Amazon, you don't get a lot of opportunities in this particular stock, but this is one of those that you do get. So Amazon is one that I'm paying attention to here for today. And lastly, a very non-traditional name. I don't talk about this very much, but I can't help to look at the technicals here, and they look fairly strong. Bitcoin. Bitcoin has continued to have a higher and higher correlation here to gold. I think this is more of an inflation play. I know not everyone here trades Bitcoin, but I do know quite a few of you that do follow Bitcoin, because some of you have asked me a lot of those questions. Bitcoin has spent a lot of time coiling below this 10,000 mark. This is the 10,000 resistance line, broke out, then consolidated for quite some time, came back to retest this as support. And I think this could be another opportunity to go long here for Bitcoin. Now, Bitcoin, obviously, you can't trade options on. However, from my perspective, the risk reward ratio here looks attractive because if this gets back into the 95, 92, 50 range, I would cut my losses, move on, risking a relatively small amount of capital while playing for an upside up into that 1250 and beyond. 1250 on the weekly chart, major resistance. If you do get that long-term breakout, I certainly think that the 10,000 level is an interesting level to potentially get long on Bitcoin, especially if you're concerned about inflation. I actually think that potentially Bitcoin is a interesting way to play inflation as an alternative to gold. Gold feels like a very crowded trade at the moment, and there are other things to consider when you're playing with gold. Bitcoin, it's something different, and I just wanted to throw that out there here as an idea for those of you that do trade Bitcoin. So with that covers what I wanted to share with you here today. Like I said, yesterday's sell-off, as violent as it was, I hope that you guys were able to, for the most part, stay on the sidelines for some of these tech names. This is part of the reason why we've been warning about these exhaustion in the markets, but this is an opportunity to get back long to the markets. This is why we've been paring down our daily play positions for the last few weeks, because we felt that as markets got exhausted, we didn't want to push too many long positions. We had very few positions in the markets, and now is the time to start adding those positions with this market sell-off. So with that, I want to thank everyone for taking the time out here this morning. I really hope that you guys find this useful in helping you better understand what happened yesterday and how to proceed forward. So with that, I really hope that for those of you that are currently on a free trial, consider supporting us and allowing us to continue to do this. You can sign up for a free trial at optionsplay.com if you're a first-time member, if you haven't signed up for the tool. And if you're currently on a free trial, I hope that you're considered supporting us by becoming a member. And this is a long weekend, so I hope you guys have a great long weekend. And it looks like I have a couple of minutes if anyone has some questions. So Robert's asking, any thoughts on Microsoft? Let's take a look at that. So, I mean, Microsoft is in the same camp as most of the other names that I spoke about, but Microsoft didn't pull back as much. But actually, it did. So I would think Microsoft is very much in the same camp here. And I like the fact that Microsoft is just at this kind of, breakout level. So you've had this triangle breakout. It came back to retest this as support. So just from a risk to reward perspective, I quite like Microsoft here. So certainly another candidate here, in my opinion. Everyone that said thank you, I really appreciate it. How do you trade Bitcoin? There are plenty of exchanges that you can do that. I would choose one of the regulated exchanges, if you will. But there are lots of places that you can trade Bitcoin. Some brokerage firms now even offer that. Is support okay for Tesla at this level? I was looking at this yesterday, and it pulled back to the 20-day moving average, which is typically what I'm looking for on a name like this. I mentioned this when it was back here. A lot of people asked me about Tesla in this range, and I said the fact that it got below the 20-day moving average, in my opinion, is an opportunity here. And you had this substantial move. That move was larger than I had expected. I was expecting a move into roughly the 400 level, a little over 400. It got all the way up to 500, pulled all the way back here. I think that I think Apple and Tesla is going to quiet down a little bit here over the next couple of weeks, because most of the gains in Tesla were driven by these short-term out of the money call options. And I think a lot of those players are going to get flushed out of the market here this week. I don't think they're going to come roaring back next week. I think they're going to be licking their wounds for a little bit. So I think Tesla is going to be quiet for a little bit. I was actually looking at, if you sell an at the money straddle here in Tesla, and I'm not advocating that everyone goes out and sells an at the money straddle, but if you sold an at the money straddle here on Tesla, the stock has to move something like 25% for, on the break even here. So we're talking about above 500 or below 300. And I just don't see that happening here over the next, few weeks or so. So, that just shows you kind of how I think Tesla is going to play out here over the next couple of days. Tony, I've got Tesla call October 2nd. Appreciate thoughts on recovery. So, if you have October 485 calls, I think it's time to cut your losses and move on. I don't think we're getting back up there. And I would imagine that you've lost quite a bit of capital on that, but it depends on where your where your cost basis is. So, you know, if you want to send me an email at info@optionsplay.com, I'm happy to kind of look at that further, Paul. Tony, Andrew's saying, Tony, if you're selling cover calls, at what point would you roll up your call or close if the underlying's rallying really fast? So Andrew, with cover calls, you know, usually about 21 days from expiration, it's time to start rolling it. It really doesn't matter whether you are in the money or out of the money. As you get to about 21 days, you should think about start rolling it. You know, unless you've reached some kind of target price on that, then I usually roll it at about 20 days. So with that, looks like the market's just opened here. As you can see, S&P is opening up flat here. The Qs opening up also a little bit lower than yesterday, but all indices are basically flat, a little bit higher here. So, you know, it seems like for now the sell-off has been stemmed, so look for some opportunities here in today's market. Thank you so much. Have a great long weekend, and I'll see you guys next week.